mentioned earlier to Laura, I am writing a book on the 1031 tax-deferred exchanges. Due to COVID-19, I have a lot more time at home. So I just finished my 22nd chapter of the book. Hopefully I will get this done. The goal is to get it done this year, but I really want to get it done by summer now because COVID-19, I got more time. In the future, when we have live classes back at Trico and Walnut and some other locations, instead of handing out notes or PowerPoint, that you're welcome at the options. Perhaps when that book is done, you can get a copy of it down the road. I intend to write this book as from the agent's perspective, how agent can understand this process, and in every aspect of it, what do you do? How do you explain to the client? Now, 1031 is an exchange, meaning you have to sell a property and buy a replacement property. Now, is that good for agents from the agent's perspective? Absolutely. You make a commission on the down leg, meaning the relinquished property side, and then you make the commission on the up leg, on the replacement property side. Now, let's get some terminology straight right in the beginning. The property that you sell, or we call it the relinquished property, the property that you're going to purchase or exchange into, is called the replacement property. So the relinquished property is the one that you sell. The replacement property is the property that you buy. The selling process, the selling side, the relinquished side, we call it the down leg portion of the exchange. And the acquisition portion is called the up leg. So down leg is the property that you sell. Up leg is the property that you purchase. Okay, I'm going to close this thing. Everybody got it? Okay, my number 909-618-3765, and you have my email address. Okay, what you're seeing on screen to the left column is the outline of my book. So this might be a good guide for today. The topic, it's somewhat complicated and technical. Most people probably know to do an exchange, you just swap properties, and then you have a 45-day rule, and you have a 180-day rule, and exchange, you can select 3 properties. That is to the extent that a lot of agents understand what 1031 is. But there are lots of other rules, exceptions, restrictions, limitations, and technicalities. We're not going to go into detail on most of these. I just want to cover the fundamental or part of 1031 today. But let's go through this guide right now. Now, what is a 1031 exchange? Okay, first you need to understand 1031 is. Okay, I always want to go through the code first. So by knowing what the law said and every single word and its legal ramification and implications, you can understand the 1031 process a lot better. Okay, then we'll talk about we'll probably not talk about property basis. That's going to be a while. What is involved? You need to understand what depreciations are, what property taxes, not property taxes, property basis are, because the whole idea of doing exchange, this is called 1031 tax-deferred exchange. Now, I hear from time to time that people refer this as a tax-free exchange. This is not a tax-free exchange. Versus Internal Revenue Code, Section 121, that's a homeowner's exclusion. If you use it as a primary residence, you can exclude up to $250,000 or $500,000, depends if you're married and filed jointly. Okay, that is an exclusion. Once the capital gain is excluded, that capital gain liability is forever forgiven or extinguished. In a 1031 exchange, the capital gain liability is only deferred when you dispose a qualified like-kind property. We'll talk about what that is. Okay, when you sell an appreciated asset, there is tax consequence associated with such disposition. Now, most people think the tax liability is the profit. For example, if the property was initially purchased for $500,000, now the property is worth $1 million. That's a $1 million profit. You would think that that would be taxable. You're right. What happens if you have a property that's $500,000 and then you sold it for $500,000? You would think that there will be no tax liability. That is incorrect, because in a 1031 exchange, the qualifying property has to be something that is productive use in a trade or for investment. We'll talk about that in a bit. But basically meaning that property have to be used for an investment or business purpose. Okay, such investment and business property is allowed to depreciate. Okay, now depreciate is we talk about the depreciation is an IRS allowable tax deduction to offset the potential income versus the physical depreciation of the property. A property in 1965, built in 1965, probably have depreciated quite a bit physically, okay? But also the property that was built in 1965 that has placed in service since then has also depreciated from the IRS standpoint. Now, physical depreciation will continue because of weather, erosion, or graffiti's man-made issue, but the depreciation from the perspective of the IRS is only a bookkeeping depreciation, and that has a limit. The depreciation for residential property generally is 27.5 years, and for commercial property is 39 years. That means if you bought the property in 1965, it's commercial property, you can depreciate it for 39 years. So that means now in 2020, that property is completely depreciated. Okay, no more IRS depreciation deductions. That means no more advantage for the owner of this property to continue holding this property, at least from the perspective of using depreciation to offset the potential income. That is one of the big pitch points for agents to pitch to the investors that have owned and hold property for a substantial period of time, especially that period of time is close to or exceeds the allowable depreciation time limit. Okay. Now let's continue. What else is going to be involved in a 1031 tax-deferred exchange? You need to know the code. You need to understand what property bases are and how to calculate them, and the substitution of basis in 1031 exchange. Your property basis is going to be swapped or shift or substituted in an exchange. Your replacement property basis, it's going to be changed with your relinquished property basis. Okay, you need to understand what those are. Depreciation, how that affects you. Now, let's talk about depreciation just briefly. As we mentioned earlier, if you acquire a property for $500,000, you sold it for $1 million, okay, your $500,000 profit, that is taxable. In another case, you bought a property for $500,000 and you sold it for $501,000, that you only have very little profit. You think that you have a very little taxes. Okay, that's not true. If that $500,000 property was purchased, let's say 39 years ago, it's a commercial property. Now, every year you can depreciate 1/39 of the property, okay, except land. If the property is $500,000, land is $100,000. So the improvement itself, the building itself, the $400,000 worth of the building is depreciable over the 39 years. It's called useful life. Okay, so each year you can depreciate substantial amount of money. So at the end of the 39 years, that $400,000 will be completely depreciated, the building portion. Now, in a 1031 exchange, there's two parts. One is capital gain, one is depreciation recapture. Depreciation recapture means if a property has been depreciated upon the disposition of the property, upon the sale of the property, the IRS will not only want to tax you on the profit, on the gain itself, but it will also want part of the tax benefit that you have received, the depreciation benefit that you have received. How much? IRS will want a 25% of the total of the depreciation that you have taken. That is called a 25% depreciation recapture. Now, so you know how significant that would be. If a property is $500,000, the improvement portion is $400,000. If that has been depreciated, okay, your adjusted basis now the basis is usually the acquisition cost. If the property is acquired for $500,000, forget about the commission and the escrow fees. Okay, $500,000 would be your cost basis, the basis for the property. Now, if the property have been depreciating or have been depreciated, the building portion, so if $400,000 the improvement portion have been completely depreciated, your adjusted basis, instead of $500,000 acquisition cost, will be reduced to $100,000. Now, if the adjusted basis is only $100,000, and now the fair market value is $1 million, and you sold the property for $1 million, not only the $500,000 profit is taxable, the remaining $400,000 depreciation recapture is also a tax liability added on top of that $500,000 gain an investor would realize. So an investor could potentially pay not only a federal capital gain tax, also a state capital gain tax, okay? And for high wage earners, that is something called NIIT tax, the net investment income tax. There's additional 3.8% tax on top of the federal gain and the state gain. How do you calculate a capital gain? A lot of people sometimes have a vague idea. Well, exactly how much tax liability an investor would owe the IRS upon the disposition of the investment property. Now, the better and clearer the agent will understand how capital gains are calculated, the easier for the agent to explain to a potential investor what the investor's exposure is if he doesn't do a tax-deferred exchange. Now, if the investor understands the consequences of the capital gain in more detail, that will help him make the decision as to doing the exchange or not doing an exchange. Now, I do have an agent from my old office that she have a client have a property in Temecula, a 5,000 square foot commercial properties that have 2 restaurants on it. The bigger restaurant occupy about almost 90% of the footprint. Offer to purchase the property for $1.8 million. Okay, and the seller doesn't know if that's a good value, so she contacted the agent. The agent is not in the investment, perhaps in the investment or in the commercial space, so she come and asked me for help. So after looking at the numbers and meeting with the owners, and I told them the property is worth, in my opinion, $2.75 million instead of $1.8 million, and you should list the property and do an exchange. Make the story short, so you decide to list the property at 6% commission, and I found a buyer and closed the transaction at 2.8 million. This is closed in February early this year. However, at the end, the owner did not want to do an exchange because the owner had some grudges about her son. Her son had been managing her properties. They have quite a number of properties, valuable properties. And the son at the end decided not to want to do the property management, not to help out. And the owner at the end, because she doesn't want to buy a replacement property, she have to handle the management headache, she decided to take a hit. She acquired a property for, I think, $559,000. And we closed at 2.8 million. And she held it for over 21 years. And commercial property, depreciable over 39 years. So she have depreciated half of the allowable useful life. So her property was what, about $600,000, maybe about $300,000 depreciation, recapture liability, plus additional over $2 million in capital gain. I hate to see her tax bill. So, but she's one of the rare investors that have decided not to do an exchange with that amount of substantial capital gain. Now, she's 70-some years old. She's retired already. She doesn't need the money. She has multiple properties in Newport Beach. So herself is in a unique situation because of family relationship. But she is a perfect target for a real estate agent to pitch to sell a property and do an exchange. Now, I have another client. His name is Dave Wentworth. Dave is an older gentleman, retired. I met him from the AOA conference. AOA is Apartment Owners Association. Some of you guys may be familiar or already a member of AOA already. So AOA have an annual trade show. They call it $1 million trade show. It's free. You guys look it up. It's in Los Angeles, in LA Convention Center. They also have one in Long Beach, also in April. I was going to attend the April conference, but due to COVID-19, it was canceled. So the other one in September. So I went to the conference and met Dave, and I just sat with him in a concession area and found out that he has a 4-unit building in Orange. And that building is worth about $1.2 million. So I asked Dave, how much loan do you have remaining on the property? And he said about $70,000 at that time. Okay, this is a number of years ago. Now the building is worth about $1.2 million, and he only has $70,000 loan left. What does that mean? That means, or not just that he's a lucky guy, that means he is a potential 1031 target. Why? Because his property is almost 100% cash equity in there. Now, I also teach a full day 9 to 4 investment property analysis class. That is a perfect combo for the 1031 exchange class. You need to know how to analyze the investment and the return aspect of the property in order to be able to pitch the investor intelligently. So I talked to Dave. Dave, you only have $70,000 left on your loan. The building worth $1.2 million. You could clear almost $1.1 million. And you're only holding a $1.2 million property. And I asked him, well, how much is your rent? His rent is about, I remember it's about maybe $5,000, some less than $6,000 a month. Okay. You have $1.2 million asset. You're getting about $5,000, $6,000 a month. Is that a good return on your equity? Not just return on your investment. There's a difference. I'm not going to really explain the technical detail. But anyway, after speaking with Dave, he came to my office a couple of times, and he decided to sell and list his property. So I listed his property for $1.2 million. And out of a casual conversation with a couple good friends of mine, Michael and Monique, which I often use the example, they have a single-family home here in Rowan Heights area on Pathfinder and Nogales. 4-bedroom, 2-bath. They've been using it as a primary residence. And then they bought a bigger home in Tustin, a 3,000-4,000 square foot of Tustin, because of kids going to go to school down there. And they converted that primary residence into a rental several years ago before they sold. They put in $40,000 in renovation, but only get $200 more a month for rent. So you rent it out for $2,700. The fair market rent was about $25,000. So you spend $40 grand for renovation, able to rent a place for $2,700, $200 more than fair market value. Is it a good investment? In my opinion, no. Okay, each month you can get $200 more. 1 year you get $2,400. 10 years is $24,000. To recuperate that $40,000 in renovation costs, it's going to take you 15, 20 years. But we haven't even talked about time value of money. He spent $40,000 converting that principal residence into a rental, upgrading it. The income he received, $2,700 a month, is every month for the next 20 years. Okay, when you discount the time value of money back to net present value, the total sum over whatever recovery period is amount to substantially less in numerical number, okay, compared to the $40,000 he put up front in remodeling the place. So make that story short again. At the end, I told Michael and Monique, hey, they are in the same situation as Dave. They have no loan on the property. Usually you'll want to congratulate them. But I told them, hey, Michael and Monique, you guys are doing a travesty to yourself and to your family. Why? You have $650,000 worth of cash locked it up in this 4-bedroom, 2-bath. And you're getting $2,700 a month for rent. And they're paying a $50 ADT security monitoring service for the tenant. Plus, they are paying the gardening. Plus, they have to pay property taxes. Plus, they have to pay the homeowner's insurance. Their net gain versus the equity in the property, if you do the calculation, your return is not very good. Once you do that, Michael and Monique, say, hey, there's something called a 1031 tax-deferred exchange, where you can sell this property, use that $650,000. You probably can clear $620,000 after your commission and escrow and other fees. You can clear $620,000. If you use that $620,000 and reinvest in a different property using leveraging, if you put down 30% or 25%, okay, you can buy a much larger property than a $650,000 asset. Okay. At the end, they list the property with me at 6% commission. I sold the property for listed for $650,000. I sold it for $660,000. I actually found a buyer, so I double-ended at the deal. Okay, and then they exchanged it into a 4-unit in Orange that Dave Wentworth's building. I told you earlier that I've listed for $1.2 million at 6%. Okay, and they purchased that building, okay, as a replacement property. In addition, at that time the interest rate is still fairly low. I think they got about 4.5% or so interest rate. They only put down 25% down or so, roughly, and they have enough money to buy a duplex in Whittier for $625,000. Now, instead of a $650,000 single-family home rental, now they have 2 properties now. One is a 4-unit with about 5,000, some 6,000, I think 6,100 in income, and the Whittier property is $625,000, okay, and has $3,100 in income. So together, they're getting a $6,100 plus $3,100, they get a $9,200 in income versus $2,700 in income. You'll think, yeah, but they are taking on a big loan. Absolutely. They took on a $1.2 million loan, okay? Because 630 net sales proceed. If you want to acquire a property that's 1.2 million, fourplex, and a 625,000 duplex, there's a $1.825 million in total asset value. So of course you need to take a $1.2 million loan. But that's how you work it. So in my investment analysis class, I will tell people to download a financial app, your mortgage app. Every agent should have a mortgage loan app on your cell phone, how to calculate loan payments. Now, that is obvious, okay? However, not only that you need to have this financial app, the loan app, that you can input the property value, the percentage or amount of down payment, the amortization period, 30 years, 15 years, or whatever period, okay, then interest rate, then we'll calculate your PI for you, your principal and the interest for you. Now, you know how to figure out the property taxes, at least in estimate by multiply it by 1.15% or roughly. Or you can look up your realist and find out what the property taxes are, okay? Insurance, you can estimate on your own. So now we know the PITI, okay, which is the overhead, the cost of carrying the property. Now, the 1.825 combined asset has a $1.2 million loan. Figure out what the interest rate, figure out what the payment is. In Michael and Monique's case, that $1.2 million loan translate into about almost $6,000 in payment and $5,900 something in payment. They are getting $9,200 in combined rent after the exchange. Okay, they have let's say $6,000 in payment. So we have another $3,200 plus. But then they have to pay a lot more property taxes, $1,000 some a month. And then there are more utilities. Your water bill is higher. A 4-unit, you have a common water meter. You cannot have the tenants put the utility, at least a water pot under their name. Okay, they have a laundry room, then common laundry room, then you have a boiler, and you have a heater, and your water bill, gas bill, or electric bill also. So also, your trash disposal is going to be more expensive for a 4-unit. Combined with the 2 units, you have 6 units. Of course, your expenses are going to be higher in terms of utilities, maintenance, insurance, property taxes. But at the end of the day, is the number. Okay, I always said in my class, you need to give the client a compelling reason for them to do a thing before they will pull the trigger. Is this compelling? If you sell your $600,000 all cash single family home and do an exchange, you carry on a $1.2 million loan. The wife, Monique, told me, Tony, we're doing this because we trust you. We're long-time friends. You know what I told Monique? I told the client, no, you're doing this not because you trust me. You're doing this because the number makes sense to you, and doing this is in your best interest. Again, let me repeat that. You tell the client, you're doing this because the number makes sense to you, and doing this is in your and in your family's best interest. Indeed, then you need to know how to compute, how to figure out if this is indeed something that makes sense, makes financial sense, and indeed is in their best interest. Now, selling a property that is fully paid for, it might cause a discomfort to some people. Michael and Monique are very conservative people. Both of them makes good money, over 100 grand a year. So they don't really need the cash flow, but it's comfortable. They have extra income and no mortgage payment. So in order in order for them to pull the trigger to do this thing of selling their all paid for rental property, you have to give them a compelling reason. One, it makes financial sense. Second, it's indeed in their best interest. Okay, so knowing how to do the numbers, we're not going to cover in this class. It's just too extensive to cover. So down the road, just go to Trico's website, look at Trico's calendar. That is a investment analysis class. Do register early. Also, the 1030 full day class, I will have this illustration detailed in full. Okay, now back again. Let's go through the code itself. What is a 1031 exchange? Now, in this virtual online class is difficult to do, but in my live classes before at Trico and other places, I often have this red envelope inside with money in my wallet. And at more than one occasion, I have offered this red envelope, money envelope, with $100 in it. And if anybody in the class could recite the 1031 code word for word and able to explain the legal ramification, they will receive their $100 tax-free. Okay. Now, I don't know how many of you can do that, and I think a good number of you might have taken my class, my 1031 class before, and I have admonished you to memorize this code and understand it really well. And if you haven't, well, today is another chance. Use a cell phone, take a picture of the code right now. Print a copy. That's why I told my last two assistants. When they first joined me in my office to be my assistant, I told them what part of their training is this. I printed the 1031 exchange code in a 24-point font or 28-point font on a 11.5 piece of paper. I told them to make several copies. One, you put it in your wallet or purse. One, you put it next to your nightstand. One, you put it in your car. And one, you put it right next to your throne. When you're doing your business or in my master bedroom, I have a 65-inch TV on the wall. So when I'm sitting on the throne, sometimes watching TV or whatever, reading, I will take out that sheet and I'll memorize whatever that I need to memorize. Okay? So what is this code? By knowing this code, you will know a whole lot about 1031 exchanges. Okay, 1031 exchange is also called a like-kind exchange. You haven't heard it before. 1031 exchange is also often referred to a like-kind exchange. What does that mean? Let's go through the code right now. In Internal Revenue Code, IRC 1031, it says, no gain or loss shall be recognized on the exchange of property held for productive use in a trade or business or for investment, if such property is exchanged solely for property of like kind, which is to be held either for productive use in a trade or business or for investment. Now you'll notice the word real in here, real property. The word real in there was not there before. Some of you might not know, or most of you might not know. Most of you would think that a 1031 exchange is only permissible for real property, but that was not true. Personal properties, like investment property, like painting, aircraft, machinery, classic cars, or whatever that is, that was exchangeable. And such disposition can be tax deferred if that personal property was held for investment purpose. However, in the 2017 Tax Cut and Job Act by the Trump administration, the personal property exchangeability has been removed from the internal code. So personal property effective on January 1st, 2018 has been discontinued. remaining, that's only real properties allowable. And not just any real property, it has to be a like kind real property. Now, what does like kind mean? Well, let's start from the code again. The code says no gain or loss. We're not talking about losses. We only talk about gains now. In 1031, deferring gains is the main goal. Losses, really not significant right now. No gain or loss shall be recognized. Now, what does recognize means? Often you will hear in 1031 exchange this phrase, in this case, non-recognition of gain. Non-recognition of gain. What does gain mean? Gain is basically the profit, the appreciation of the property as a taxable liability. That's what gain means. No gain or loss or no capital gain, or no profit, okay, shall be recognized. Recognized meaning not recognition of gain meaning IRS will consider the investor has tax liability in the year when the property is sold. Okay. Recognition of gain meaning the IRS will consider the taxpayer has tax liability in the year when an appreciated asset is sold. Okay, so now you know what that word recognize means in the code. No gain, no capital gain or profit. Okay, no gain or loss shall be recognized on the exchange. So in order for the taxpayer to receive the non-recognition of gain treatment, the taxpayer have to do an exchange, okay, of what? Of real properties. What type of real properties? Held for productive use in a trade or business or for investment. Let's break down this part a little bit. What does productive use in a trade mean? Now, if you're a carpenter, you use the real property as a carpentry shop to make your cabinets. Or you're a screen printer, you're an embroiderer, using the facility to do embroidery, to do screen printing. Or you're a CPA or attorney, or a realtor. Matter of fact, the Trico office in Walnut is a real property held for productive use in a trade, isn't it? Then it could also say, is productive, you held for productive use in a trade or business. Now, the key operative word here is or, and that's important, okay? If you don't hold the real property for the purpose of productive use in a trade, you can still qualify for 1031 exchange. If you hold a property for business, a law office, a dental office, a medical doctor office, or any other offices, okay? A retail store, a retail business, grocery store, a warehouse, okay? A commercial building. Are they used for business? Yes. How about your 4-unit apartment building that you own, or duplex, or your 16-unit apartment building, multifamily building? They are for rental purpose, isn't it? So they are held for investment, for one, for productive use in a trade. You can say productive use for income production. Okay? Investment property is for income production or for future appreciation. Okay, so either you use a business, the real property for business, or use it for productive use in a trade for your own particular whatever business you're doing, or for investment. If you don't use it for business, you don't use it in the productive use in a trade, you bought a piece of raw land in Lancaster or wherever 20 years ago, and that land has been vacant, no crops, nothing, generates no income. Does that qualify for a 1031 exchange? Lots of agents sometimes are confused. Okay, what what property or properties that qualify for an exchange? Does a 2-unit duplex have to exchange for a 2-unit building? Does a 2-story building have to exchange for a 2-story building? Can a commercial property be exchanged for for a residential property and vice versa? Can a retail store or a dental office be exchanged with a piece of land, and vice versa? Okay, knowing this code clearly, you would understand what kind of property can be exchanged in this tax-deferred exchange process. Now, again, the code says no gain or loss shall be recognized on the exchange of property. What type? Held for productive use in a trade or business or for investment. You buy land for the investment purpose. So if the land does not produce any income and is not involved in a productive use in a trade or not involved in a business operation, yes, it still indeed is a qualified exchange property. Okay? Now, let's finish. No gain or loss shall be recognized on the exchange of property held for productive use in trade or business or investment if there's a condition. If such real property that we mentioned earlier is exchanged solely, okay, solely meaning for no other purposes, you have to exchange that property that we talked about earlier, exchanges solely for real property of like kind. What does like kind mean? The code following, it explains. Like kind is which is to be held. That means you also need to hold this property that you're going to be exchanging into, okay, either for productive use in a trade or business or for investment. So now you know exactly what type of property is qualified to be exchanged. One, on the relinquished side that you sell, it must be held for the purpose of productive use in a trade or business or for investment. And you must exchange this relinquished property for another property, and only for the type of property that's also held for productive use in a trade or business or for investment. Therefore, any property qualified for these 3 categories of productive use in a trade or business or for investment are therefore exchangeable. So regardless if this is a chicken farm, a cow farm, or crop farm, or a retail outlet, or a shopping center, office tower, multifamily building, single family, condo, duplexes, all of them can be exchanged. Okay, so everybody clear? Okay, then let's move on. Let's go back to the outline. Property basis. Property basis in short means your acquisition cost, okay, minus your expenses. That is your net acquisition cost. But the adjusted property basis is that net acquisition cost minus your cumulative or accumulated depreciation taken. Okay, if you don't quite get it, don't worry. Down the road, just come to maybe perhaps a live class. Then you will know, or when the book comes out, you can read it, or you can just Google it. Okay, depreciation. Okay, we talked about a little bit earlier what that is already. Depreciation is also called cost recovery. Cost recovery. And that's allowable depreciation period. Like I said, residential property generally 27.5 years. Commercial, 39 years. Now, when does depreciation start, or when can an investor take depreciation? Okay, the depreciation, it does not have anything to do with the building's age. If the building was built in 1965, or if the building is built in 2009, it makes no difference. Okay, again, the year of the building is irrelevant in terms of the IRS portion of book value depreciation. Okay, the depreciation starts, or an investor can take depreciation when the investment property is placed in service. When the investment building is placed in service. Meaning, if I acquire a building in 2014, okay, and that building is in such a bad shape, it took me 6 months, 9 months to renovate the place. That portion of time is not depreciable. When the property is placed on a market, a tenant comes in and rents it, then starting from that time, the property is depreciable. Now, what happens if a tenant vacates, it takes you 2-3 months to rent out the unit? Is that period placed in use, quote unquote? Is that period depreciable? Yes, it is. Even before the tenant occupies the place, the time it takes to advertise the place, to show the place, okay, all that bit is considered place and use as well. Key point to take away, depreciation is irrelevant with the building's age, okay, or the year the building was built. Depreciation is mandatory. It's not electable. If an investor have neglected to report or take the depreciation deduction when it comes to selling the property, the IRS will recapture the depreciation that you were eligible for, that you should have taken or you have claimed. Okay? Now, Michael and Monique earlier, that owner for that single family home in Roland Heights on Pathfinder near Nogales, the husband was doing the taxes. Okay, he didn't hire a tax accountant. He didn't know a rental property can be depreciated or can take depreciation. Okay, now primary residents are not qualified for depreciation deduction benefits. Okay, only investment properties, business properties are qualified for depreciation. Land is not depreciable. The land portion of a property, if you purchase a property, not just the land, but have a building in it, the land portion of it is not depreciable. Only the improvement, meaning the building, is depreciable. Okay, Michael did not take depreciation for the 5 years that the property had been leased out. So I told him, contact my CPA, Archie. Okay, Archie can amend up to 3 years of the past 3 years that you did not take the depreciation. So what he didn't know hurted him. Okay, not only he did not receive the benefit of using depreciation to offset his passive income meaning rent. Okay, also when it comes time to sell, 25% of the eligible depreciation will be recaptured if he didn't do a 1031 tax-deferred exchange. Fortunately, he did do the exchange, following my advice. Now, he didn't even know what 1031 was before. And the family was not even aware there was such a tax deferment mechanism where he can defer not only his capital gain profit, but also his depreciation recapture. So agents, what you don't know hurts you. What you don't know or what your clients don't know hurt them. So learn the stuff as much as you can, as best as you can, as clearly as you can, and not only learn the stuff well, but learn to articulate and present what you have learned in a clear, concise, easy to understandable manner, so the reason will be compelling, or the reasons will be compelling. Like again, your client is not going to list the property with you or sell his property if you don't give him a compelling reason. Okay, lots of times the clients might not even think about selling. Okay, or they thought about selling but have a lot of hesitation one way or the other. You need to figure out a solution for them. Okay, as if you were the owner. Under what circumstances would you list the property and would you sell the property? Or would you exchange the property? Does the number make sense? Is that in your best interest? Okay, those are the two main things that you need to be aware of. Okay, why do a 1031? We'll cover that later. Talk a bit already. At the end, right now, I finished on the 11th side. I finished 24 chapters already. In the next couple months or so, I'll be working on the exchange benefits. Okay. Now, some of you have attended my class before. Here is one of them. You might want to take a picture or screen capture it, or just review the recording. You will get this printout from me in my class. If you want to email me, I'll be glad to cut and paste this for you as well. Okay. Now, keep in mind, what you're seeing right now is my draft of the book, okay? And if you see something here, it might not be perfectly worded right or whatever, okay? This is only my draft, okay? I want to finish my manuscript within the next couple months or so, or by summer. Then I'm gonna have to read over everything again before I submit to a publisher for review and for print. But nonetheless, this constitutes a really good outline of what a 1031 exchange involves. Let me just scroll through and cover some of these chapter headlines for you. So you need to know what capital gains are, what depreciations are, what depreciation recapture tax liability is, how are they calculated, okay, federal gains, almost 12 o'clock already. I'm only covering the service. Okay, I want to answer this one question. An agent had posed a question yesterday that a property was purchased a long time ago and have appreciated substantial value. I think she mentioned it's about $4 million, and the acquisition cost, I think, I don't remember exactly what that was. I think she said it was 500,000. So that's hypothetically, let's say 500,000 acquisition, 400,000, $4 million fair market value. You have a $3.5 million in gain, very substantial. Not even talk about recapture. This is a single, not a single family. It's I think she says it's a farm property that the owner used it as a primary residence, but at the same time, they use it for for horse training as part of the business on the property. The question is, can they sell the property, capitalize on the 121 exclusion, which is the homeowner's exclusion, and do a 1031 exchange at the same time and defer the rest of the gain? Let's go through quickly the 121 exclusion on chapter 17. Now, the 1031 exclusion, most people understand it as you get a $250,000 per individual, $500,000 for a married couple filing jointly. That is to the extent of how most agents will understand it. That is correct. However, that is lots of technicality also. Okay. Now, of course, you need to use that property as a primary residence, and you need to hold it for 2 years or more. And then that 2 years has to be within the most recent 5 years. Most agents say, I know that. Okay. But also that 2 years, it doesn't have to be consecutive. That means you don't need to live in the house as a primary residence 2 years in a row. You can live there for 1 year, rent it out, live there for another year again. So far, if you live there cumulative of 2 years or longer within the most recent 5-year period before the disposition of the property, before you sell the property. Okay, I knew that. More rules. Depends in the manner of the property's acquisition. How you acquire a property and how it was used immediately after the acquisition will affect your 121 exclusion, because there's some new legislation that put in place. Okay, not new, but since the inception of 121, there are some changes to it. Most people think, so far, if I lived there for 2 years, that'll be okay, including my cousin. My cousin have a property in Rancho Cucamonga. I used to live out there too. So for more than 20 years now, and they're thinking, hey, it had been rented all this time. So she said, oh, if I move back there for 2 years, then I can get the full $500,000 exclusion because property appreciate quite a bit. Yes and no. Okay. Right here, you have the primary residence requirement, qualification limitations, exceptions for a 24 months rule, and that is something called a 121 allocation rule. And then that is the last rule. Okay, what does that mean? Then you have surviving spouses and all the other things. It depends on the manner the property was acquired. Let's go to that section. Okay, some of you in the business long enough, you know about the 1034 exclusion. It's the rollover provision before, where an owner of a primary residence, they can sell, then they can within a certain time, 2 years or so, they buy equal or in value, and they can defer their capital gain. That 1031 exclusion have been repealed and replaced with this 121 homeowners exclusion. Okay. Tax strategies, rental properties. Okay, now there are several scenarios. The general several situations where properties of 2 different uses can be combined to achieve tax exclusion and tax deferment benefits. Okay, what are this situation? 1, non-exchange property. Okay, it was acquired in the beginning, but it's later converted into a principal residence. Okay, so first, you bought the property, not for primary residence use, for rental. Okay. Second, an exchange property converted into a primary residence. Now, this particular property, okay, you're using it as a primary residence now, but when you first acquired, it's still a 1031 exchange. You receive this property as the replacement property. So in this case, it's a different scenario. Okay. 1, you bought it. Yes, you didn't live in it. You rent it out. Okay. Later on, you convert it into primary residence. Second, same thing. You acquired it. You didn't live in it. You convert it into primary residence. It seems like the same, but they're not the same. In the second case, in the latter case, if the property was acquired through an exchange, there are different rules. Okay. And further, and the principal residence is converted into a like-kind property. So you bought it in the beginning, you use it as a primary residence first, then you convert it into rental property. Now you want to move back in and convert it into a primary residence. Okay? Oh, that's not confusing enough. There's a 4th situation. It's called split properties. Okay, you bought the property, you use it partially for business or for investment, use it partially for primary residence. So what are the rules then? Are we still able to exclude the 250 or 500,000? Okay, it really depends on which situation you're in. Okay, for example, the property that we talked about earlier, the $4 million fair market value now. Okay, it was used or have been used partially for business. Okay. Can you capitalize on 1031 exclusion? Yes, you can. Okay. Yes, you can. How you allocate that is most likely because of footage. For example, if you have a 2-story home, my CPA, also the guy that I played racquetball with a long time ago, he does my taxes. He did my taxes. I don't use him anymore. He have a house in Newport Beach, but he also maintains a primary residence in West Covina. It's a 2-story older building. Okay, The downstairs he used as a tax office to do taxes. Upstairs he lived there, and the weekend that he goes to his Newport Beach home. So he claimed his San Bernardino or West Covina, San Bernardino County, West Covina home. That's I don't know San Bernardino, LA County, but anyway, he claimed half of his home as business, half of his home as a primary residence. In this case, if the upstairs and downstairs have the same footage, 50% will be primary, 50% will be for business. Now, as realtors yourself, you probably know how to do this, so you're ready in terms of allocating your home office. Okay, if you use one of your bedrooms or one of your whatever areas in the home as an office, you probably can deduct it as an expense. Same thing in allocation. If 25% of your home is used for business, percentage-wise, you probably can use that 25% as a ratio. So the other 75% you claim a primary residence, and whatever that fair market value is, that you can exclude up to. Okay, again, the limitation is up to $250,000 if you are an individual, and $500,000 if you are a married couple, and if you're filing your return jointly. Okay, now that 121 exclusion is only up to $250,000 single, $500,000 total. In the present case, if the property has $3.5 million in appreciation, forget about depreciation recapture. Okay, 500,000 exclusion is really hardly anything. It's less than 50% or even 25%. You can combine that with the 1031 exchange, and not only defer the capital gain, but also the depreciation recapture. So you can defer the remaining gains through a combo of 121 and 1031 exchange. Go back to a different scenario here, separate from what we're talking about. Okay, if you acquire the property through an exchange, okay, not only you have to live there 2 out of the most recent 5 years, okay, you must own the property for 5 years as well. Okay, versus if you bought a home, you live in it, you bought a home 2.5 years ago, you've been living there for 2.5 years, now it has a tremendous gain, you want to sell it, you can take the full 121 exclusion. Okay, if you acquire in the beginning as a primary residence and you live there for less than 5 years, no problem. As long as you live there for 2 years and use the property as your primary or principal residence, you qualify for 121 full exclusion. However, if you purchase a property or acquire a property through an exchange, okay, and that property must be held for at least 5 years, and if you live there 2 out of the most recent 5 years, then you qualify for the 121 exclusion. But more technicalities. If the property was rented out in the beginning, you didn't live there, okay, and you lived there for only 2 years, you don't get the full exclusion. That's allocation rule comes in play. The new rule says that if the property was acquired and rented out first, okay, and you lived there the last 2 years, the first, let's say you bought it 5 years ago, rented for 3 years, you lived for 2 years, okay, now you only qualify for 2/5 of the exclusion, okay, because you rented out you lived there for only 2 out of 5 years, okay, and that 3 years will be allocated. The 3 years that you rented out, the gains will be allocated for that portion, okay? But then there is a last use rule. If you rent the property out first, then you live there for 2 years, then you know you're subject to the allocation rule. You don't get a full exclusion. Then what happens if you rent the property out again for the last year or so? Okay, the Internal Revenue Service said if the Internal Revenue Service will not challenge the qualification of the exclusion. If the owner have lived there 2 out of the 5 years, and the last use of the property is a non-qualified use. Meaning, if the last use of the property is a rental, not a principal residence, you can still claim the $250,000 or $500,000 exclusion. If I have totally confused you, maybe we play this recording. I think Laura said this is recorded, right? Okay, or Google it, or when my book comes out, and you can get a copy and read it at that time. So, okay, Laura, I think we are way over time already. I'm only scratching the surface. Any questions? Yeah, I can go on and on. I hope this is helpful. That's so many. Let me maybe just briefly finish the categories. Chapter 5, you have exchange like-kind properties. We can describe that a little bit. Both the relinquish and replacement. What are non-like-kind properties? Primary residence exception. Exceptions. There's also exception for property held for sale and for resale. Personal property conveyance of improvement without land. Yeah, a lot of exchange requirements. Briefly on the exchange requirements, the 45-day, 180 days rules. These are really basic and fundamental, but absolutely important. There's something called 45-day identification period, meaning when you sell a property, you need to buy another one. You need to exchange it, right? IRS want to know, what are you going to buy? Which property are you going to buy? You must tell me within 45 days after you sold your property. Now, the word sold is really used it really loosely. So in my manuscript, I don't use the word sold. I use the word transfer or dispose, meaning when you sold, yeah. When you're under contract, the property is sold, escrow haven't closed, title haven't changed. When the property is transferred, meaning the title has transferred. When the property is disposed, meaning the deal is done, title is transferred, escrow is closed. So, so I don't use the word loosely. The property is not sold. The property is transferred or disposed. Okay. When the relinquished property is transferred or disposed, starting from the next day, you have 45 days to the midnight of the 45th day to identify, meaning to tell the IRS what property you're going to be exchanging to. Okay, I'm not going to go over the identification process, but you know there's a 45 days. Okay, and the exchange must be completed within 180 days, starting from the day after the relinquished property has been transferred. Okay, that's another catch. That 180 days will become an important thing if your transaction is toward the end of the year. Let's say after October 16 or 17, toward the end of the year. Why? Because it's not just 180 days. Okay, it's the 180-day or the earlier of the exchanger's tax filing due date. So if the tax exchanger's filing due date is April 15, if your transaction ends in December 31st, you only have January, February, March, half of April, which is only 105 days roughly. You do not have the full 180 days. Okay, it's the earlier of the 180 days or the taxpayer's filing due date. But that early of the tax filing due date, including extensions. So tell the investor involved in the 1031 exchange, even if you're ready to file your taxes, do not file. File an extension instead to maximize your 180-day exchange period, even if you don't think you might not need it. Okay, who knows? Murphy's law says what goes wrong will go wrong. So bracket yourself, cushion yourself with the maximum margin. Okay. Now, property identification. There are 3 rules. Okay. After I finish these 3 rules, I think we're going to conclude. There's so much stuff, but these are most fundamental. how do you identify a property? IRS said, I have to give you some rules. There are 3 property identification rules. Let me see if I can go to that section here and let you do a screen capture at least. Property identification. Where did I put the property identification rules?
Tony,
Yes.
I'm going to step away. I need to start getting ready for my 1 o'clock
Okay.
committee
Okay.
meeting I have.
Whoever want to, you guys, I know it's over that 1 hour limit, but whoever want to stay, you're welcome to stay. And I want to find that 3 rules for you so you can do a screen capture. Probably I'm going to do it right here. It should be in this section right here. Here we go. Oh, see, I haven't even this thing is not even right here. This is number 2. Okay, you see, I haven't even finished my book yet, so this should be 1, 2, and 3. Okay, if you guys want, use a cell phone camera, take a picture. These are the 3 rules. Okay, the first one is the 3 property rule. That means you can identify up to 3 properties. Now, in order to qualify for a full deferment, you need to, the investor have to buy equal or greater in value. Okay, that is not the only requirement. Okay, it's one of the many requirements. One of the main 3 requirements. One of the main 3 requirements is you need to buy equal or greater in value. Second, you have a debt replacement. What does that mean? That means you need to maintain at least the same or equal loan liability as a relinquished property. Third, you need to reinject all your equities, okay, in the relinquished property and put it into reinvest it into replacement property. Okay, these are the 3, at least the main rules for full 100% deferment, plus a bunch of technicalities, exceptions. Okay, so these 3 main property, the 3 main property identification rule, the rules. The first one is a 3 property rule also, meaning you can identify any of the 3 properties, regardless of value. Okay, first rule, you can identify up to, not have to be 3, up to. You can identify 1, 2, or 3. You can buy 1, 2, or up to 3. Okay, in exchange, you can sell 1, buy 1. You can sell many, buy 1. You can sell many, buy many. Okay, you can sell basically 1 for 1, many for 1, many for many. Okay, and any combination. Second rule is called 200% rule. 200% rule says if I sell a relinquished property for 1 million, I can only identify properties up to 2 million. Now, but it allows you to identify more than 3 properties. Okay, you can identify 4 single-family homes. Each of them are 500,000, so amounts to 2 million. You can exceed more than 3 property. You can identify more than 3 property, but the combined value cannot exceed 200% of the relinquished property. Again, you can identify more than 3 properties, but the combined value of the property you identify cannot exceed 200% of the property that you relinquish. Okay. Then that's the last rule. It's called a 95% rule, or called a 95% exception. It's when a situation, the 3 property rule is too limited, and the 200% value is too limited. IRS allow you to identify the property with the 3rd rule called a 95% rule, meaning you can identify unlimited number of properties with unlimited value. However, you need to purchase 95% of the combined value, not by 95% of the number of the property you identify. Okay, that means if you identify 100 properties, you don't need to buy 95 pieces of those properties. Okay. However, if you use the 3rd rule, the 95% rule, you need to identify, you need to buy 95% of the combined value. Okay, it's the aggregate value that you need to purchase 95%, not the number of the property that you identify. Okay? The last rule is often confusing. I hope I have made that clear. I hope I, in my drafting, in my manuscript, will make those texts clear enough. So in case you don't want to do a screen capture, you want to have this text in an editable form, so you can send to your client, email me. I'll be glad and copy and paste to you. Again, my email address is, one more time here, I'll type it for you. For those that came in late, I'll give you my cell phone number also. You're welcome to call me. My cell phone number, you write it down, I'll screen capture it. Okay. It's 20 minutes over and we're only scratching the surface. But I hope you guys get something, at least something valuable today that will help you in your real estate practice. I teach a number of classes at Trico. 1031 is a full day course from 9 to 4. I teach an investment analysis class. It's highly recommended if you plan to do exchanges. It's from 9 to 4 also. I teach a commercial property class that includes leasing. Leasing is a huge part of commercial property. That is also a 9 to 5 class, 9 to 4 class. I teach a advanced contract class, and useful contractual clauses. That's very useful. That's a free class from it's only 2 hours. I have another class, Opportunity Zone. You're not familiar with that. It's created under the 2007 Tax and Job Act that will not only allow tax deferment, okay, it will allow actually capital gain exclusions. So if you don't find those, sign up for Trico. Those classes are free. I have another class that I teach. It's a 2-hour free class. It's the listing and selling business opportunities. Like you're selling restaurants and business, do that. I'm not sure if I teach any classes. I don't remember. But let me bring up my class schedule here. There's an upcoming seminar. Oh. Okay, I'll just paste it over here so you can see it. Okay, just go to Trico's website. You guys are Trico member. For you guys that are not Trico member, just Google Tri-Counties Association of Realtor. Tri-County Association of Realtor in Walnut. Go to the calendar section and you can see all the classes listed. My next class will be coming up on May 13th. It's a landlord and tenant property management class. I was requested to do this class again. I have this webinar on this class last month. We'll cover quite a bit of COVID-19 issues, non-payment of rent. What are the moratoriums, evictions, tenants protection? I try to cover as much as possible in that particular class. By the way, I also do property management, and I'm also a HOA manager, managing an HOA out in San Gabriel Valley. I also have a construction company on the side to help clients do constructions. So you guys have related issues, you are welcome to give me a call. Okay, everybody, have a fantastic day and continuing successes to you guys. And I hope to see you guys in a live class soon. I really miss the interaction with you guys. I haven't heard from you guys for so long, seen you guys for so long. You guys sometimes do give me a call. Okay, everybody, take care and have a good day. Bye now.
Thank you, Tony.